Hello everyone, welcome. Today actual is the second part of risk and money management topic. Welcome Barak, I can see that you are the very first person that commented, welcome. So guys, another session exclusively for risk and money management. So it's a bit of a combination of how vital the risk and money management is, and we can also see together the steps that you need to follow in order to ensure risk and money management into your strategies. So it's quite a complicated topic, but it's vital. It's vital. It's your card for becoming a successful trader. So it's absolutely vital, like in every other business. If you have your business plan, you have done your risk assessment, your risk management, and appropriate money management as well, then the odds of succeeding are getting greater and greater. So before we start, as usual, I need to go through the disclaimer warning. By the way, I have put a handout, the slides in a handout version into the handout section, so please free to download it. The slides the material that I have provided include also last week's webinar. So for everyone that didn't join us last week, don't worry about it. I have included everything that we have seen last week as well. So I would like just a quick feedback regarding the audio. And until I get a feedback from you guys, I'm going to go through the disclaimer warning as usual. These materials provide as a general marketing communication for information purposes only and does not constitute an independent investment research. Nothing in this communication contains or should be considered as containing an investment advice or an investment recommendation or a solicitation for the purpose of buying or selling of any financial instrument. All information provided is gathered from reputable sources, and any information containing an indication of past performance is not a guarantee or reliable indicator of future performance. Users acknowledge that any investment in leveraged products is characterized by a certain degree of uncertainty, and that any investment of this nature involves a high level of risk, for which the users are solely responsible and liable. We assume no liability for any loss arising from any investment made based on the information provided in this communication. This communication must not be reproduced or further distributed without our prior written permission. Risk warning: trading leveraged products such as Forex and derivatives may not be suitable for all investors as they carry a high degree of risk to your capital. Please ensure that you fully understand the risk involved, take into account your investment objectives and level of experience before trading, and if necessary, seek independent advice. So, any legal documentation that you might need, it's on the website. Feel free to read our full risk disclosure as well. Everything is online. So whatever you need is there. If you cannot find it, please check with our support agents. We have a live chat on the website, so feel free to ask anything you need. I would like to remind you that this webinar is recorded, so as soon as we are done, I'm going to ask from the team to send it to you via email. In some cases, unfortunately, it might be in your spam or junk folder, so please always check your spams or junk folder. So, for any direct questions, queries, and etc., please feel free to contact me directly at webinars@hfm.com. So, thank you for the feedback, guys. Thank you, Visamin. Thank you. So I'm going to skip the intro. And let's check together what we will cover basically today. So, oops, sorry, wrong tab. It should be on the other hand side. So we're gonna focus on risk management, just a bit of a reminder of what it is, why it's so vital, money management as well. And then we're gonna see together the steps that you need to follow and what you should consider in order to put everything together, in order to prepare yourself before any entry with an adequate risk and money management. So it's like putting all together: entry options, target options, stop losses, and etc. So let's move on. A bit of a reminder over here. Oh. No? Okay. Excellent. Okay. Sorry, guys, just a quick reply to someone. So just a quick reminder of what we have seen last time and what risk management is and why it's so important. So you can see this pyramid, right? So this is the complete guide of having a proper, complete strategy, okay? For succeeding in financial market in general, I'm not going to focus solely on the online trading and the derivatives trading and etc. I will take the whole industry as a whole. So in order to succeed in risk in the finance industry, there are four actually key components. Okay. First of all, is to have a strict money management. Having a strict money management requires to have a complete strategy. What that's supposed to mean? It requires to have a strategy with some particular steps that you need to follow in order to ensure that what you have done, whatever it takes to maximize, okay, your odds of eventually succeeding. So these are the key components: strict money management, complete setup or complete strategy, if you want to call it this way, predefine entry and exit signals, and obviously the identification of a trend before you take any position in the market. So very, very briefly, risk management. What do we mean risk management? Because I don't know how many of you have been here last week, so I'm going to repeat a few things. Risk management. What is a risk management? Risk management is exactly what is named after. Is identifying. In general, is the process of identifying, evaluating, and mitigating risks of losses in an investment. Okay, risk of losses in an investment. You can tell me, Andrea, why? Why should I evaluate the losses? Because by identifying them, by evaluating them, you will manage to limit them. So risk of loss arises when the market moves in the opposite direction of our expectations, right? That's why we need to ensure that we have a complete strategy in place. We have identified the trend beforehand. We have determined beforehand the entry and exit signals. And of course, we had arrange how much we're gonna risk. We're gonna do some proper money management in order to secure a big part of our capital. So that's why the trends are for. That's why all these tools are for, in order to use them and identify and prepare ourselves the best we can before taking an entry and risking our capital. Remember that the trends are formed by the investors' risk sentiment, and it's something that can be influenced by multiple factors, right? There are multiple factors that can affect the markets, can affect the price fluctuation. But with these 4 key elements, we try to control a bit, to limit as much as we can the risk of losing due to these factors. I'm referring to factors such as political events, economic releases, policy, central bank policy announcement, interest rate decision, business events as well, such as the new technology, AI, and etc. So by having these key elements and ensuring that you are excellent on that, and you are improving yourself day after day on these elements, you limit the risk. After all, something that I pointed out several times last time, after all, remember that it's your money, right? It's your money. So respect them. Respect them, because the market will not do that for you, will not respect your money. You have to respect your money. And something that I keep saying also when I'm presenting webinars that are related with trading plan, or how to prepare your own trading plan, your trading journal, etc. Remember, guys, that this is not just a hobby. Okay, for some people it might be a hobby, okay, but some other people, and the majority of the other people, are actually it's a business for them. They want to succeed. They want to have an extra income from it, right? So treat it like a business, because it is a business. Okay, so like every business, it requires a business plan, right? So in this case, we in the finance industry, we have trading plan, for example, but treat it with this way, because having a plan and strategy is the only way, okay, to increase, to basically learn from yourself. First of all, it's a constant learning for you, but you will increase the possibilities of becoming a successful trader. Plan, strategy, plan and a strategy also controls your emotions. If you have one and you are following it, that is a way to control and to manage your emotions as well. Never, never, never trade impulsive. And always do what you understand, what suits you. Don't follow just a colleague or someone from in a forum or something. If there are people that they post their plans, their strategy, and etc., don't blindly follow someone. If it doesn't make sense to you, don't do it. And I put, like, it's an example, basically. Put some numbers on an a case study, let's call it, just to show you how important, okay, is an appropriate risk and money management. So as I said, what is a risk management? Basically, is a way to identify, to evaluate and mitigate as much as you can the risk of losses in your trading, right? Money management is is the process of placing the appropriate amount of money in order to ensure your capital, okay, to safeguard your capital. And this is a case study just to make you understand why the risk and money management are vital. Okay, so I'm gonna read it. I'm gonna go through it. Okay, some of you might already read it. So I'm gonna be straightforward, because after is simple numbers, is simple months, simple probability. So let's assume that you try the old tossing a fair coin game. I don't know how many of you are flipping coins, remember? When we want something, or we want to, I don't know, play first or something, you flip a coin. So yeah, say you try this old tossing a fair coin game, okay? And you double your money, $5, let's say, each time, in the hope that you will end up a winner. So what that means, I mean, that I'm playing, let's assume that I'm playing with someone else. I'm picking which side I want, but every time I'm losing, I'm doubling. I'm doubling my $5 in order to break even, or even to end up a winner in the end, to gain. Like, let's say we flip a coin, I invested, I put $5 on, I lose. On the next game, I say, okay, no, now let's put a stake at 10. I lost again. A third time, let's put the stake 20. So I'm doubling in order at the end to. So let's assume that we're doing that. By doing that, by doubling my $5, that means that it's like my basic premise is that I have a 50-50 chance, right? So because it's a coin, it's a 50-50 chance. So let's assume that one could ascertain, right? Let's make an assumption that, you know what, it's impossible to lose for 10 times in a row. There are many people that think that way. Said, okay, yeah, I'm doubling, eventually we'll win. And they're thinking that, let's make the assumption that one could, someone, I mean, I'm playing, say, oh, I'm gonna double, and there is no chance to lose in a row, 10 times in a row. That's wrong. That's a wrong mentality. That's a wrong statement, a wrong assumption. It is possible. It's very possible. It's not wrong. Okay. Maybe the chances are, for the first few times, I could be right, but it is possible. So if I want to succeed in this game, or you as traders, you want eventually to profit, right, and become better traders, to be profitable traders in the long run, you shouldn't do any of these assumptions, okay? Not assume that it's impossible to keep losing. It is possible. So don't like trade. What I'm trying to say over here is that don't trade just without doing the necessary study, and you just rely on luck, because this is relying on luck. This is relying that, oh, there is no chance to lose for 10 times in a row. I'm gonna keep doubling my money until I end up in profit. No, that's the wrong mentality. So remember that in the example of a fair coin, right? well, there is the heads and tails, right? Two outcomes, 50 chances. So each time there is a bet, it's like a new event. It's new event. There is no correlation, right? It's a new event. Every time we flip the coin, it's a new event. There is a new 50-50 chance to end up in success. But this statistically, okay, it's statistically inevitable that you will get 10 losing bets in a row, which turns that $5 stake into 2,560 losing streak, because remember, we were doubling the stake every time. So by losing 10 times, that means a losing strike, losing stake, sorry, 2,560. 2,000, we started with $5. It might be statistically inevitable, but it can be possible, right? So if instead of the 2,560 is if I have 10 losing bets in a row, which turns that $5. But if we were multiply by 5 of each loss, not by double, by 5. So $5 the first bet, 25 the second bet, 125 the third bet. So multiplying by 5 times for each loss, then that ends up with a losing strike $9,565,625 after only just 10 coin tosses. I put this case study on just to show you how important, okay, how important is the risk and money management, because over here we have this case study is the definition when someone does not understand how important is risk and money management and actually doesn't understand what is risk and money management. This is a precise example, a precise case study to represent how vital risk and money management is and why you need to make sure that you fully understand this, the importance of it. Okay, so just food for thought. That was the only reason why I put that case study on. Over here, it's a brilliant book. I don't know how many of you read it. If you haven't read it, try to find it online. There might be some free versions as well. Excellent book from Jack Swagger, with not only explaining what is risk management, the importance of it, but actually it also has some very nice strategies in order to risk management strategies in order to minimize the losses if the market tides turns against you after an event or something. We all know, right, that the risk actually, you know, even though the temptation of realizing every opportunity is there for all traders, right? We must understand and we must know the risk of an investment in advance. Okay, this is where the money management comes from and the risk management comes from. We need to know the risk in advance in order to ensure that we can afford it, in order to ensure that we can endure if things go sour. All successful traders know and accept that trading is a very, very complex process, right? So an extensive Forex trading risk management strategy needed, trading plan needed, because they are the only tools that allow us to have a sustainable income source. So, what I have over here, I have steps that each one of you should follow, right, in order to ensure that they have done whatever it takes in order to increase their risk management techniques. Basically, this is a trading plan, the steps for a trading plan, right? You need to initiate, you need to scale in, to scale out, square off. These are the necessities for participating in the market. But these represent risk management. So first of all, what do you need to do? You need, these are the components, the very, very, very briefly components of having a good trading plan, right? Because the main difference between the successful and unsuccessful trader is the quality of their trading plan and their risk management strategy. This is it. So very, very briefly, a good trading plan and a good risk management strategy. I'm going to show eventually where the risk management strategy comes, when it's where exactly you will place it in your trading plan. These steps outline a good trading plan. What you need to do first? Focus on which financial instrument you would like to trade. What trigger your attention? Then define when to enter and exit your trades, right? Where to set our profit and loss limits. How to determine successful and useless actually opportunities. What to do when the market turns against you. How to deal with your emotions. How to deal with your emotions is related with these steps, because these steps will ensure that you will not leave your emotions to drive you. So identify the financial instrument you want to enter. Decide your entry level, right? If it's successful and goes along with your speculation, you can add to a position. If it turns against you, you can reduce your position, scale out. Make sure that you have in advance determined exit levels. You could also consider re-entering the same or opposite direction. This is for this technique, many traders use the SAR, stop and reverse system. Another technique, mechanism, we could say, is hedging a position. This is one way to neutralize or manage directional risk. Or you might just hold cash, being neutral, right? All these techniques, mechanisms, whatever, all these should base on the violation or penetration of a price trigger, not merely a signal. So there are two key parts of of a trading plan and a strategy, a risk management strategy. There are these two questions that you need to do to yourself. The very first one, how much do I need to break even? Question number one. Because why? By doing this question, will lead you on assessing how much risk you can afford and how much you are willing to risk, right? How much capital you are okay committing per trade, right? And understanding in advance all the costs. This is vital because this considering the risk, how much you want to invest per trade, how much it will cost. This will help you determine your stop loss, your entry level, your exit level, etc. They're part of risk and reward ratio. Also, time and risk. Always try to set realistic trade objectives. Always time your entry. Always having in mind the possibility of a downside risk, of the possibility of the market turning against you, just to ensure that your loss will be, your potential loss is not something that could harm your account. It's all about money management objectives. So I mentioned before that you need to scan your market and identify and to focus on the financial instruments that trigger your attention. But you need to put in place trigger levels and signals. I mean, someone of you, maybe one of you that considers a trigger point, something that could trigger his attention, will be an evening's affirmation, or something that could trigger his attention will be the turn of the Heiken Ashi candles, or something that could trigger his attention will be the change of parabolic SAR. There are many different triggers. Okay, you need to find the one that you understand. They were it's easy for you to read it on time. It's something easy for you. So because the triggers are most of the times are entry levels as well, right? There might be price based, and there might be non-price based, right? Might be a pattern, breakout of a pattern. It might be, if they are price based, there might be at a particular price because that price used to be a very strong resistance level, for example. So there might be price, but there might be non-price one. There might be based on the volume. There might be based on the momentum. Okay, there are many trigger points. You need to find the ones that you feel comfortable with. If you are a person that likes your main part of your strategy is momentum, then a trigger point, an entry point, could be the change of momentum from positive to bearish, or the breakout of I don't know, stochastics above 30, or so. Not necessarily price-based ones. Okay, price-based is considered to be the best one, but if you have a nice plan, it doesn't mean that it needs to be always a price-based one. The non-price based ones, favored by algo trading and a more systematic one. Okay, just for you to have it in mind. So that's my personal setup, we could say, routine, we could say, but each one of you guys should have one. That's what I do. But each one of you should, because I'm based in Europe, so that's why. And I like this kind of routine, but each one of you has his own, right? Depends on where you're living. What's your daily routine? Are you going to work early in the morning? Are you a person that works in shifts? Are you a person that has a family? So you have free time only in the evening. So that's the plan, the steps, the not steps, the plan, the routine is solely based on your personality, based on your free time and etc. This is what this is what my routine is. So what I do every day is scan daily, right? Late in the night when at the close, the US close, if I'm awake, okay, usually I am, and very, very early in the morning before coming to work, okay? But I don't have, I have a lot of, charts on. So I like scanning most of the major forex pairs, gold, oil, silver, copper, platinum, palladium, some stocks as well, the big ones. And I have them all indices, obviously, Nasdaq, Dow Jones. So I have always this on, always. So I have arranged my platform with this way. And I have daily, I'm checking the daily charts, first of all, okay? Okay, so I'm scanning daily. And if something triggers my attention, okay, then something that I haven't put on, then I scan into a 4-hour chart in order to get a confirmation. But, as I said, I'm scanning in a daily basis at the close and early in the morning in order to spot any possible entries, trigger levels. If I find one, if I found one, I open a position on a leave alone basis. What that's supposed to mean? Because I'm in a daily setup, I open a position with a stop loss, take profit, in order to leave it for the rest of the day or the week, depends on how long term is the position. So I can't spend time during work worrying about positions. Setting stop loss and take profit is the number one for having a risk management, right? At the equity level, by the way. So it's vital. With this way, you're controlling your emotions because you don't have to worry and you don't have to stay on your platform and then get stressed and etc. But also it's a risk management technique because with this way you are locking profits or you have predetermined a possible loss that you are okay with it. That is just a tiny part of your capital and it will leave you in the market in order to come the next day and trade again. So risk management managed by lot size is absolutely vital. So stop loss, take profit, and an appropriate position size. Because even if I put a target, even if I put a stop loss, but I have put a lot size so massive that is like I'm risking all my capital. So what's the point? Where's the risk management over here? Nothing. In a single trade, I could lose everything. So position size, right? A very nice technique is to try and use multi-targets. It's something that I have provided a multi-target webinar in the past. You can find this in the past webinars website. With this way, you are locking profits. If you can use trailing stop, for example, and you can lock profits, but also you will ensure you will ensure the 80% of your profits by hitting the first target, and then only the 20% of your position will be in risk for the rest of for target 2. So with this way, even if with this way, even if target 2, second target, never breach the second target, even if it suddenly starts falling or whatever comes against you, you have already locked 80% of profits with target 1. This is vital. This is actually the definition of risk management, right? Risk and money management. I put some, okay, I'm not gonna go through it, but this is some examples of common signals, trigger levels in order to consider a trade. But this is just for you to read and maybe consider adjusting in your existing trading plans, okay? Other than the usual MACD, stochastic, I mean, a crossover of the oscillator lines is something that is a trigger. It's a possible entry level. Cycle turns, correlations also. There are a lot. These are some examples just for you to consider if you want to. Furthermore, more simple one, previous support and resistance levels, derived price levels based on sequence, like counting bars, counting candlesticks, counting bricks, if you're using Renko. There are a lot of ways, triggered signals that you can base your entry level on. Some more complicated ones, some more simple ones, like divergence, a bit more complicated ones, but it's one of the most powerful signals. Do you use it? Yes. Trailing stop is another definition of risk and money management, right? Because it moves along with your trade, with your price action. So you're locking profits on spot, and if the market starts coming against you, trailing stop stops, so you cannot lose your existing profits. It's from there onwards. Trailing stop is an excellent way of actually it's something that you should consider, guys. It secures profits and secures with this way limits even more the amount of any potential losing capital. Also, possible signals. Remember that the signal indicates potential bullishness or potential bearishness, so a potential rally or a potential drift. Signals are part of a setup, like it's a setup which lets you know, alerts you, as I point out here, to a potential entry level, potential price trigger in the anticipation of a reversal or a breakout of a support or a breakout of a resistance, and etc. Or sometimes signals can be based on an extreme condition. If you have seen an overextension of your price, or an exhaustion of your price, or an overextension or exhaustion of your oscillator. So you remember that RSI above 80 considered to be of a bot, right? So this is a signal that eventually could slow down. It's a signal that indicates a potential bearishness. So just something just to have in mind regarding, I don't know how many of you have used non-price signals, guys. Are there any of you that use non-price signals? Just 2 points that you need to be alert on regarding non-price signals. A non-price signal how can I explain that? So because there is the possibility of a divergence, right? This is what might be wrong sometimes with non-price signals. So when we have a significant divergence between the price and the oscillator or indicator, then the non-price signals will be wrong. So yeah, it's the divergence. That's the thing in non-price signals, because it might gives you the wrong signal, okay, or give you a signal well in advance, while the divergence might be proven correct like many days afterwards, or many hours afterwards, or many months afterward, depends on which time frame you are. So the diversion will often misdirect the trader, or if you are using an automatic system, into believing that the trend is changing because of the momentum loss. But the trend might change. For the trend to change might take a long time, or it might never change, right? So this is the key. Divergence might often misdirect you. So be careful if you are using non-price signals. Maybe you can cross-check them with some support and resistance levels, and etc. So yeah, when you have spotted the divergence, even if you feel absolutely comfortable on taking a trade, make sure that you confirm this potential trend change with price action. Okay, this will ensure you that your non-price signal is correct. So price is your confirmation for such signals. A system, okay, a system that you can consider, or just so always look for energy, look for turning points and trends, right? So so possible tools that you could use: moving averages, right? A breach of and a break of moving average is a breach and break of a key support and resistance levels, so they could be used as targets, as entry points, sorry, or potential targets as well, but in this case it's a possible entry points. So this is a setup, this is my system based on the routine that I explained earlier. Daily charts, scan them late at night when the US market close, and very early in the morning before the EU market opens. Okay, you don't need to follow that. This is just my own setup, but you can. This is just food for thought. Okay, so possible entry level is the 20-day simple moving average, if it's regarding day charts. Sometimes I shifted to 50-day moving average, 50-day moving average. That depends solely on the asset and whether the 20 gives me a better and a clearer trend than the 50 and vice versa. Possible targets. I mentioned that having multiple targets is an excellent way to have an adequate risk and money management in place. So one way is ATR. I have demonstrated in the past. So by considering you can use a guy's ATR for setting multiple targets. So your first target could be the ATR value. Your second target could be double of the ATR value, or 1.5. So 1.5 times the ATR value. And if you're using a third value, it could be twice the ATR, and so on and so forth. Always, that depends on the asset that you're trading. Sometimes ATR, the 14-day ATR might not satisfy the particular asset. Sometimes I need to deduct it to 7 ATR, or sometimes if an asset is if I see from the historical data that it tends to hit halfway of the ATR, I consider putting the first target in half of the ATR. Okay, so always you need to adjust these techniques based on the financial instrument that you're checking, and on his historical performance. So you go back, check whether this system works, how you can adjust it in order to work as good as possible. Okay, it needs an adjustment, always needs adjustments. And stop loss, possible stop loss levels. Maybe sometimes I'm using pivot points, sometimes I'm trying to manually find support and resistance levels based on the history. Obviously, if I notice that it retested several times the same resistance, there was a strong ceiling for the asset, then this is the immediate resistance level for me. So if I'm gonna if there is a short position, then stop loss at the previous resistance is a nice place to put your stop loss, or simply below the latest high or the latest low. Or you can use your Fibonacci's. You can see me several times using fractals as well, or RSI, as I explained. This is an example of bad and good divergence, right? That's why I mentioned if you are a non-price based person and you have spotted diversion, make sure that the divergence is in line with the price. So do a price confirmation to make sure that the diversion, it doesn't misdirect you. So you see, down, this is down, but indicator is moving up, so there is divergence. So that proven correct indeed. That was that was the beginning of a new uptrend. But there is also over here, however, we could see that the here, for example, the price is rising, but the momentum is detecting. That's a wrong signal, because indeed it continued to the upside for many months. That was a nice divergence. So price up, but momentum down, and indeed it fall temporarily, but fall. So be very careful. You need to always set objectives or targets. That's some predetermined price level to exit or adjust your position management. So ways to tighten your stop loss. Okay, so you should consider buy or sell limit orders, right? I'm referring to buy and sell limit orders at the profit level, okay? Or buy or sell stop orders, right, for reaching your objective. Or okay, that's basically on Fibonacci ratio. So make sure that your risk and reward ratio is in line with your projections, right? If your risk and reward ratio is 1 to 3, but you decided to put your target far away, and you end up, when you measure, it wasn't a 1 to 3 risk and reward, but it end up to be 1 to 10. No, the projections are not in line with the risk and reward ratio. So make sure that the risk and reward is based on your projections. Consider technical levels, which you can use either as entry levels, take profit levels, stop losses, and etc. Ichimoku lines, support and resistance levels, and etc. Alternative, overlay indicators, barriers, moving average. A break of moving average is another way to enter a trade or to set your target. Ichimoku, gun levels, and etc. Okay, we mentioned counting the candles, we mentioned patterns, and etc. Another thing that you can keep in mind, you see, consecutive, like in a range, eventually break it. So it was a breakout of a triple bottom. That's a sell opportunity. Breakout of a triple top, buying signal. A coarser bottom. An upside breakout of a symmetric triangle, and it broke it above it, and it exit and it move above it. That's a buying signal. So you can place pending orders based on that, by the way, right? Sell signal and descending triangle has broken. Ascending triangle broken. This looks like this is a pennant, uptrending channel. So every time it rebounds away from the support, this is a long position. Every time it pulls back away from resistance, it's a sell opportunity. So a lot of ways to consider as trigger points. Always have a journal. Have a journal. What you have done, what positions you have taken every day, how long you are holding your positions open, what was your entry level, what was your target level, how much, okay, I don't have everything here, but how much you have risk per trade, and how much you profited or lost. Keep a journal. Keep a journal. Is the only way to learn from your mistakes, right? It's a constant learning. Having a journal and write down what you have done every day and every week and every month will keep you in line with the market, and will help you reassure that you are not over trading, you're not you're not over trading basically. And with this way also you learn what you did wrong, which kind of setup end up in a losing trade. Maybe you can avoid it or you can amend it in order to work better for you. So with this way, this is a way to improve yourself. Okay, I'm gonna skip that. Is another example. Stops. Make sure that you always put stop levels that can fully or partially close at a profit or a loss. So it might be fixed levels, might be trailing stop losses, okay? And you should always base your stops on price. The stop losses are not like the trigger levels that could be non-price ones. Stop losses must be priced levels, must be based on prices. So specific levels, either specific support levels for long, specific resistance levels for long, previous high, previous low, particular Fibonacci levels, particular channel levels, particular triangle levels, but it needs to be price-based. It needs to be fixed. I mean, it needs to be in a particular level. Whether it's a trailing stop or loss or not, whether it's a fixed stop loss or a trailing stop loss, it doesn't matter, but it needs to be on price-based. Always, also something that I forgot, it could also be, they could be fixed on dollars, they could be percentage or volatility based. What I mean, for example, trailing stop could be, you could place your trailing stop 30 pips away from your entry, for example. Or you can place your trailing stop or your stop $10 away from your price. So you can place your stop loss on a fixed dollar, or it could be fixed dollar one, or a percentage or pips or whatever, okay? Some configuring and non-configuring price and filters. One is the price filter, the other one is the time filter. Chart one, volume, combination of all. But some other ones could be a breakout, as we said, or a reversal. So it's a confirming price one, or another filter that we could use is just try to avoid any noise. Okay, wait the market to calm down in order to filter out any voice, and avoid with this way some false alarms or false breaks. And so, for example, every time that the NFP is coming, there is a lot of noise, so that ends up with a lot of noise, a lot of false breaks. So you might consider not to trade the news in order to filter out any non-confirmed price breaks. Okay, that's not so. So in order to identify what kind of filter you can use, that's basically solely on your personality. Are you a selective person, an aggressive person, a responsive person, a conservative person? So check these bullet points, okay? So are you a person that is you respect, actually, are you a risk averse with respect to time seeking risk, with respect to entry? Are you someone that is risk seeking with respect to time and price? Are you risk seeking with respect to time of entry but risk averse with respect to price? Are you risk averse with respect to time and price, so you are more conservative, more choosy one? This, if you do these questions to yourself and you figure out what are you, whether you're selective, aggressive, responsive, conservative, this is your true attitude to risk. Yes, if you identify and you understand yourself with making this question to yourself, you have to understand what kind of attitude you have, is a very significant step in order to limit as much as you can this risk appetite. Remember, understanding ourselves is vital. Always remember, scared money never win. Don't try to chase for winning trades. You're scared, okay? Don't trade. If you're confident, then yes, that's key in order to win. But if you're scared and not feel confident, then confident enough, remember that this is something that never wins. Trade only what you can afford to lose. Do not use borrowed money. Never. You must have patience, discipline, control, and try to cut your losing trades. Don't trade because oh, no, I'm losing, but it's okay. I will eventually, it will eventually turn. No, cut your losses short. This can be achieved with a trading plan and a risk management strategy, as I explained earlier. So, other than having a trading plan and a risk management strategy, something that can help you is the 1% rule or the 2% rules. There are two rules, very famous rules, the 1% rule and the 2% rule. And I put an example of the 1% rule. So let's assume that they have an account size up to 5,000. So what the 1% risk rule states that I can risk only 1% of my account. So only $50 per trade, only $50 per trade. Also, set some limitations. Limitation on the number of trades per day or the number of per trades per week, the number per trades per month, and etc. This keeps you in control. So 2 trades per day. Win rate 60%. These are some parameters that you need to place predetermined in advance and keep it this way. Don't change it, right? Because it's your tools for an appropriate risk management. Risk and reward ratio 1 to 1.5. Okay. So put some parameters, right? Risk and reward ratio, win rate, how many trades you need to you have decided that you're okay opening every day. Risk management is the 1% rule, so only 1% of your account size. So what that means, it means that winning trades, with this 51% rule, that means that considering the winning rate is 60%, so 0.6%. You are placing 480 trades a year, and your risk and reward ratio is 75. Okay, this means 14,400 400 winning trades. That's not okay. Losing trades is 40%. Multiply the 480 trades a year, multiply by the 50, right? That ends up with 9,600, right? So that ends up with 96% a year and ends up with 8% per month. So what that means, why I have done all these months, in order to show you that even with a 50% win rate and a 1.2% ratio, right? There is a 4% risk per month, so 48% a year. So I know that this you don't understand what I'm saying right now. So I'm gonna go straight to the example so I can show you what that's supposed to mean. Look at the parameters, right? We said we determine risk and reward 1%, profit per trade, like based on our risk and reward ratio, 1, 2, 1.5, right? This is what we determined earlier. 1% risk, 1.5 reward. So this is the risk and reward ratios, right? Number of trades per week is 10, to a day that equals 10. Number of trades per year, so this is the scenario of 10 a week, so 520, okay? It's wrong, it's 480, but nonetheless, it's the same. Success ratio, we set 60%, right? Number of winning trades since the success ratio is 60%, so that means 60% of 520, then this means 312 possible winning trades and 208 possible losing trades, right? So this is the 208% of total loss in losing trades, and that's 468% profit in winning trades. So that will return us at the end of the year 260% profit. Okay, so I have done multiple scenarios, okay, by changing the profit risk and reward ratio. So here it was 1.2%, here it was 2%. Here I changed the success ratio. Here I increase it, deduct it. So I changed several parameters, right? And look at that. The higher the risk, the higher I set the risk, the more the chance to end up in loss. Look at that, 10% risk, 100% loss in the yearly return. 20% risk, 946% loss due to losing profits at the end of the year. So always do a bit of an exercise with several risk and reward ratio in order to see how vital it is to have a reasonable risk per trade, a reasonable profit per trade, and a reasonable success ratio, okay? So with black is the ultimate scenario, the scenario that gave us the higher profit returns. That was with 1.8% risk per trade and a 2.3% profit per trade. So success ratio is 70%, right? So that's why I said there are two rules, the 1% rule and the 2% rule. They both seem I have it somewhere, right? The 2%. No, I don't have the risk 2% rule somewhere. I think I have it somewhere. Okay, never mind. One possible way to, something that you can adjust to your plan is the 1% rule. Obviously, it's not something certain. I mean, You can use it, or you might don't want to use it. You might want to put your risk percent higher, but try to do at least to complete such a table in order to figure out, right, the most appropriate combination of risk and reward. So over here we have a starting equity 5,000, a risk percent 3%. So this means $150 risk per trade, okay? And we have multiple winning and lose ratios and multiple risk and reward ratio. By completing the numbers, we could see that the best possible results, that they don't require very, very high risk and neither a very, very high loss, it was these ones, right? You can tell me, but Andrea, the next lines, they have greater profits. Yes, but this represents loss as well. So try to complete such a table in order to find the balance risk and reward ratio along with the winning and loss ratio, right? So here for a 3% risk, right? Basically the risk over here, based on the table, we should deduct the risk into 2% with a win and loss ratio 4:60 or 50:50, right? Guys, it's been too long. Over here, I put some technicals in order to help you. Some examples of bullish signals, some also a time frame confirmation. So for example, in my daily routine, I'm checking first the daily and then get the confirmation with a 4-hour chart. But there are many ways that you can get some confirmation for your possible potential entry. First of all, stick to a particular time frame that it suits your personality. Once you select to you this time frame, stick on it. So look for signals on that particular time frame. Now, in order to confirm your signal, you might consider going one step backwards. So if you are a 4-hour trader, you can check for confirmation by checking the 1-hour time frame. Okay, one up, one down, one step up, one down, no more than 2 steps down. Okay, so for a 4-hour chart, you cannot go down to 15 minutes chart in order to get the confirmation for your entry. No, that's a mistake. It's okay looking for multi-time frame confirmation just to make sure that what you have, what triggers your attention in the time frame that you trade, but make sure that it's just one step lower. So if you are in a 4-hour trader, go to the 1-hour chart. If you are a daily trader, go to the 4-hour chart, and so on and so forth. If you are a 1-hour trader, go to the 30 minutes chart for checking for a confirmation of the bias or divergence or whatever. Then trigger levels. Try to find for reasonable entries. We have shown some example of possible trigger levels. Okay, and predetermine your stop losses and target levels. Always predetermine your attitude to risk, right? And the levels that you're gonna enter. You're gonna set targets, you're gonna set stop losses, you might possibly add to your positions, you might possibly reduce your position by exiting earlier, an exit level as well, or any scenarios that you might consider re-entering the market. Okay, all these should be predetermined. Okay, we have covered that. Know when you will get out before you get in. a very famous quote. Because a great risk management system can make an average method successful, but a poor and a weak risk management system can and often does ruin your successful system. Have this in mind. And I will do a very last few steps, very last few slides, just to show you how vital these are. Can someone of you tell me, what do you prefer, scenario number A or scenario B? A certain 100% gain of $50,000 or 80% chance of a gain of $75,000 and a 20% chance of a zero gain? A. Only Barak replied. I move on. Another question, what do you prefer? A certain 100% loss of 50,000 or a chance or an 80% chance of a loss of 75,000 and a 20% of a zero loss? A. I guess the A was for the previous question. I don't expect anyone to choose A in this case. Martin, B for that case. B, okay. Very logical questions. So, as expected, you reply as most people did, by choosing A in the scenario of a gain and B in the scenario of on the question 2. But choices are irrational, as you chose the smaller expected gain or the greatest expected loss, because guys, the 80% loss of $70,000 is $60,000. So you chose a greater loss than you should. Do you understand what I say? And you chose less gain than you should, because 80% chance of a gain of $75,000 is 60,000. So your reply should be the vice versa, B and A. You get what I mean? That's okay. The experiment worked because this is what most people chose. It's a human mentality, it's a human mindset. We chose we make irrational choices, like what you did earlier. You chose the smaller gain or the greatest loss. So it's human nature regarding risk and reward, unfortunately. We are risk averse. Humans are risk averse. So when it comes to risk, okay, sorry, when it comes to gains, we are risk averse. When it comes to risk, avoiding losses, we are risk takers. Without understanding, I mean, it was an irrational choice, but the theory is correct. It's the theory of prospect by Kahneman and Tversky. So this theory explains why traders let their losses run and cut their profits. This is the exact opposite of what you should do. Trading is a mind game. So if it helps you, try to convert your potential losses or your potential gains into dollars, into actual money, in order to understand and in order to make appropriate choices Because as I said, when it comes to gains, we are risk averse. When it comes to losses, unfortunately, we are risk takers, and this is a human nature, I'm afraid. So, vital, check your fundamentals, check the sentiment, the mood of the market, whether there is any risk or risk on, risk off mode. Check your technicals, risk management, vital for success, and always time your entries. So this was the end of the webinar, okay? Okay, I have MT5 over here, right? Ways, you see, there are obviously you can have pending orders. You see stop loss, you have buy limit, sell limit, buy stop, sell stop, buy stop limit, sell stop limit. I can see that Carol wanted a demonstration. Also, sorry, just a second. Let me check the questions, what exactly you want to check, for me to check. Okay, so okay, you are referring to the filtering. If I'm not mistaken, okay, something that I should, maybe I should consider a demonstration, but not today, because soon I will have a live analysis, guys, okay? So can you, both of you, send me an email so I can compose an email with all the ways you can filter. You can filter in MT5 and MT4. I think MT4 is not possible, but in MT5 it is, in order to introduce you the filters. There is no time right now. I would appreciate, though, an email so I could compose an email with all the details regarding on how to filter, to add filtration in your MT4 and MT5. Okay, so yeah, obviously it's always the forum MQL5 has this material, but yes, please email it to me, because there is no time right now. There's only half an hour before the live analysis, so I need to get prepared. Yeah, I will put some steps on. Okay, and there are indicators that they are filtering out. Okay, indicators that you can download from the forum. Okay, so yeah, so I'm gonna call it a date. Thank you very much for attending. Take care. Soonish we're gonna have the inflation out, so it's expected to add some volatility into the market. So yeah, if you're in a hurry, you can search for filters in the MQL forum page, and you can download one. Okay, in the meantime, I would appreciate an email, and I will compose back some steps that you can follow in order to apply filters in your MT4 and MT5. Thank you very much. Have a great day ahead, and see you later on with the live. Bye-bye.